Welcome to The Deep Dive, the show where we take complex financial events, cut through the noise, and deliver the critical insights you need. Today, we are conducting a deep dive into Saratoga Investment Corp, that's RR, following their fiscal second quarter 2026 financial results webcast.
And we're slipping into our talk tickers mode for this one. Our mission really is to unpack those hard numbers, dissect what management was actually saying strategically, and try to understand that core disconnect, the friction point that clearly drove the market reaction this week, because shares definitely took a hit after the call.
Okay, let's jump right into that because, the market reaction was pretty negative. Shares traded down significantly, and that immediately tells you investors are seeing some kind of crucial weakness in these results, right?
Well, what's fascinating here is how the market seemed totally focused on the income side, almost ignoring the balance sheet strength. It's a real split narrative. On one hand, you've got what I'd call pristine asset quality, really strong, and solid net asset value growth too. But then, the income performance, it lagged substantially.
Give us the headlines on that split then. What are the key numbers?
Okay, so the headline disappointment was the adjusted net investment income, NII, came in at just $0.58 per share. And that number immediately set off some alarms because it's a noticeable step down from where they were last quarter. But the quality story, that was the anchor they kept coming back to. Net asset value, NAV per share, actually rose to $25.61. That's up 0.4% sequentially, so positive there.
And the real tension point, I think, is the dividend pledge. Because even though they only earned $0.58, management kept that quarterly dividend run rate steady at $0.75 per share, paid out in those $0.25 monthly bits. To me, that's not just an earnings miss. It feels like management making a pretty loud statement about their strategy.
That is the critical distinction, absolutely. Management is clearly prioritizing avoiding future losses over, let's say, maximizing the short-term dividend payout. They're almost operating like a conservative capital preservation fund hiding inside a BDC structure, and the market's kind of punishing them for it right now. Although they did highlight their LTM return on equity, ROE, is 9.1%, still comfortably above the BDC industry average of, 7.3%? So they'd argue their long-term strategy is working.
Okay, let's dig into that core issue then.
Yeah.
Income. Where exactly did the NII pressure come from? Why only $0.58?
Right. So the main drag was a pretty significant decrease in the net interest margin, the NEM. That margin dropped sharply. It went from $15.1 million in Q1 down to $13.1 million in Q2. Management pointed to three key things behind that $2 million drop in non-CLO interest income. And it tells us a lot about the current lending environment.
Could walk us through those factors.
First, they had a slight dip in average assets, about 1.1%, mainly due to portfolio repayments. Simple enough. A loan gets repaid, that income stream just stops immediately. Second, there's that timing lag, The income from repayments vanishes instantly, but the full interest impact from new loans, well, that takes time to actually flow through the books. And third, they saw a minor squeeze on the weighted average interest rate for the main BDC portfolio. It ticked down from 11.5% to 11.3%. That reflects those earlier SOFR base rate decreases finally hitting.
So portfolio churn, some rate movement pressure. Okay.
Yeah.
But wasn't there also a technical headwind, something hitting the per share number specifically?
That's right. Good point. A crucial detail if you're tracking those per share metrics, there was a 2-cent per share dilution impact. That came from the shares they issued through their at the market or ATM equity program during the quarter. They raised capital, which is fine, but it immediately hits that NII per share calculation.
Okay, so here's where that tension really ramps up. Dividend coverage. You've got $0.58 in NII against a $0.75 dividend payout. That's $1.70 per share gap just for this quarter. It instantly makes you question if the dividend is sustainable. But management held firm. How did they try to convince people this wasn't, reckless?
Right, and this is where we absolutely have to talk about the strategic role of spillover income. Management basically used two main lines of defense. First, they kept saying they're confident about future accretive asset deployment. They believe their deal pipeline will eventually close that gap organically. We'll see.
Okay, confidence in the future. What's the second line of defense? The immediate cushion.
Exactly. The financial cushion they have right now is substantial. It's this large reserve of remaining spillover income. They estimate it's somewhere in the mid $2.30 to $2.50 range per share. And for listeners maybe less familiar with BDCs, spillover income isn't just like spare cash, it's actual previously realized earnings that haven't been distributed yet. So management is basically using that, let's call it $2.40 cushion to buy themselves time until they find the deals they like, deals that meet their standards.
Got it. So quick math. If that $1.17 per share gap continues, that spillover income covers the dividend deficit for, what, roughly 3.5 quarters? Maybe a bit more. That's a powerful buffer, yeah. Management's basically telling the market, look, trust our discipline. We can cover this gap for a while without hurting the balance sheet.
That is precisely the message they're sending. They're signaling loud and clear. Balance sheet strength and disciplined underwriting come first. Even if it means adjusting the dividend doesn't perfectly match this, sort of. Short-term income dip caused by portfolio churn and timing.
Okay, let's shift gears then. Let's focus on that defense. Asset quality and liquidity. Because this really is the cornerstone of the bullish case for SAR, isn't it? And frankly, it's what sets them apart right now in what feels like a pretty challenging private credit market.
Oh, absolutely. The credit story is pristine, just full stop. Non-accruals dropped to only one investment, Pepper Palace, and that represents just 0.2% of the portfolio's fair value. Now, put that in perspective. The non-accrual rate at cost is 0.3%. The BDC industry average right now, it's hovering around 3.4%. So Saratoga is dramatically lower. They are managing risk exceptionally well.
And wasn't there a specific positive reason for that drop, something showing active management?
Yes, exactly. They made a point of highlighting that one investment, Zage, which had been historically challenged, was successfully returned to accrual status. That single action drove the improvement. It proves they're actively working the existing portfolio, not just, sitting back and waiting for perfect deals to land in their lap.
Okay, but this brings us to that key risk, the one that clearly worried investors. Deployment speed. They've got this massive pile of dry powder, almost $407 million in total investment capacity. That includes what? Over $200 million in actual cash, plus another $136 million from those low-cost SBT3 debentures. And just for you listening, those SBIC debentures, that's cheap, government-backed financing, a really significant advantage for BDCs that have access to it.
Right. And management explicitly said they think they can grow assets by over 40% without needing to tap the equity markets at all, which naturally raises the big question investors were asking. If you have that much low-cost capacity, why aren't you deploying it faster? Why not close that NII gap?
I agree. That's exactly the friction point. Is this admirable discipline or is it just paralysis? Because sitting on cash when you're under-earning your dividend, that's a huge opportunity cost.
Management was actually pretty candid about the environment. They admitted M&A activity is, muted. And there's intense competition out there that's pushed spreads down while leverage levels across the middle market remain pretty high. So they're sticking to their guns on underwriting standards, focusing heavily on first-lien and unitranche deals. That's 84.3% of the portfolio now. Very conservative structure.
And they specifically called out the competition, didn't they, in a way that was quite revealing, saying larger players are coming down into their lower middle market space, offering simpler, easier covenants.
Yes. That phrase, simpler, easier covenants, is absolutely critical. For you, the listener, covenants are basically the legal promises in a loan agreement that protect the lender, right? Simpler covenants mean looser protection if the company borrowing the money starts to struggle. And management flat out confirmed they are actively rejecting those kinds of deals. They're choosing discipline, choosing loss avoidance over just rushing to deploy capital to hit a short-term NII number. They're literally choosing to under-earn the dividend rather than take on what they see as excessive risk in the current market.
That is a fascinating strategic stand to take right now. Okay, let's move to a strategic spotlight.
Yeah.
The CLO debate. A decent chunk of the new originations, $26.3 million, went into BB and BBB rated CLO debt securities. Now, given the, let's say, checkered history of CLO equity exposure that really hurt some BDCs in past cycles, how did management justify putting capital there?
Yeah, they spent some real time clarifying this, precisely because it's a sensitive topic for BDC investors. They were very clear. They are investing only in the debt tranches. These are securities generally rated investment grade or maybe just below. They explicitly said, we are avoiding those highly volatile residual equity slices, the stuff that really burned some of their peers back around the GFC.
Okay, so if it's not the risky equity, what's the appeal of these specific CLO debt slices right now? Why buy those?
They view it as opportunistic, a highly diversified investment class. Their internal research team apparently thinks they have an edge in picking the right tranches. The main attractions seem to be, one, enhanced yield. They mentioned these new CLOs are yielding somewhere in the 8% to 10% range, pretty good. And two, crucially, this allocation adds an element of liquidity to the overall portfolio. That's key. Unlike most private credit loans, these CLO debt tranches are generally tradable. That's a big benefit when you're trying to manage, $407 million in dry powder effectively. They even indicated they're comfortable with this CLO debt allocation maybe growing towards, say, 10% of the total portfolio over time.
All right, time for our favorite segment where we pitch an outrageous but plausible trade idea, fit from investment committee discussion perhaps.
You said correct.
Remember, everyone, this is absolutely not financial advice, for entertainment and discussion purposes only. What have you got for us?
Nice. So given how the market absolutely hammered SAR based on those $1.58 NII concerns, while seemingly ignoring the huge capital preservation focus and that pristine credit profile, the trade idea here is a relative value play. Go long Saratoga, SAR, short a peer BDC that has clearly documented credit stress.
Ooh, I like the setup. It directly plays on that tension.
Yeah.
The market's current obsession with immediate yield versus SAR's obsession with quality. Walk us through the rationale for pairing those.
Right. The market's being short-sighted, just looking at the $1.58. The long SAR leg is designed to capture the upside from the eventual deployment of that $407 million in dry powder. When they deploy that capital responsibly, which is their whole mantra, it will inevitably close that NII gap and should restore full dividend coverage. Now, the short leg, shorting a pure BDC that maybe has a similar headline yield but demonstrably higher non-accruals or maybe a weaker balance sheet, that serves two critical purposes.
Which are?
First, it acts as a hedge against any sector-wide shocks like sudden interest rate volatility, protects you a bit. Second, it provides potential alpha, excess return. If that stress peer does eventually run into credit problems, which seems more likely if their non-accrual rate is way above SAR's 0.2%, your short position pays off.
Right. So you're essentially betting that when the next inevitable credit hiccup hits the middle market, SAR's superior underwriting, you see it in that tiny non-accrual rate, you see it in the high 10.8% insider ownership aligning interests, will cause its valuation to hold up much, much better than its stressed peers. It's really a long-term quality bet disguised as a short-term volatility hedge, designed to generate a positive spread on the pair trade, regardless of these immediate NII fluctuations.
Precisely. You're betting that discipline eventually gets rewarded, maybe more than the market currently appreciates, especially relative to peers taking more risk for yield today.
Okay, so let's recap. We covered those conflicting signals. The disappointing $1.58 NII, mostly driven by that deployment lag and some margin pressure, versus the undeniable strength of the balance sheet, that massive $407 million in dry powder, and the incredibly clean credit book.
Yeah, the core strategic choice management is wrestling with right now is balancing that need for immediate dividend coverage against what they see as an imperative, maintaining disciplined underwriting, especially in a market where they explicitly say competitors are relaxing standards, offering those simpler covenants. They are making a very clear, very strategic bet on long-term quality over maximizing short-term yield, and they're using that spillover income as the bridge to get there.
So a final provocative thought for you, our listener, to mull over. Management has clearly signaled they will not compromise credit standards even if competitors are loosening terms. Will this impressive discipline pay off faster than the market's patience runs out? Or could that $1.75 dividend become unsustainable before deal flow really picks up? Definitely keep a close eye on their deployment rate next quarter. That will be key.
Thank you for joining us for this deep dive into Saratoga Investment Corp. As always, continue your own research, analyze those strategic risks, and we look forward to discussing the latest financial moves with you again soon, right here.